Hello and welcome to the Gold, Goats, and Guns podcast for March 7th, 2023. My name is Tom Luongo, and we have a lot to talk about. It is episode 136, and I have with me Ted Oakley, who's the managing partner and founder at Oxbow Advisors. And I had a chance to sit and chat with Ted for a couple of minutes before we started recording, and I really thought that it was very interesting that we're going to take a step back from kind of the high level strategy, geopolitical wrangling, and all of this stuff that we currently usually do around here, and just get kind of into the nitty gritty and pick the brain of somebody who actually has to manage real money in this insane environment. So I thought having Ted on the show would be a good counterpoint to some of the things that we've done in recent episodes with Daniel DiMartino Booth, with Vince Lanci, and with Lynette Zhang. So Ted, welcome to the show. Thank you for taking the time today.
Thanks, Tom.
All right. So, from what I understand, right, you actually have to manage money in this insane environment that we have, where we have the federal government running massive deficits. You've got the Federal Reserve on the other side of it. Jerome Powell just came out this morning at the Senate testimony, throwing another monkey wrench into the idea that the Fed is going to pivot anytime soon off of high rates. And markets reacting violently to this. As a matter of fact, I don't know about you, but I was watching it just before we got started today, and I was like, wow, oh, look, the euro is getting crushed, the yen's getting crushed, gold is getting crushed, blah, 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 blah. What are you seeing at this point? And how are you trying to, navigate for the people that you're managing money for? How are you looking? What are you looking at right now as the dominant thing, or, the dominant, area that people should be concerned with? So take it away.
Tom, I think what's happening is, and I'll give just a little bit of overview, is that I think what's happened, and particularly in the last 25 years, but certainly the last 15 years, is that between the Federal Reserve and the fiscal money that's been put out, we've really ruined what I call price discovery, or the investment system. Mm-hmm. And what it's done with people is they're all off balance.
Yeah.
I think people think, I have no idea what's going on, what to do. Every day is different. And then they start concentrating on, for example, Jay Powell, mm-hmm. when, in our opinion, the Federal Reserve group, really, from Greenspan on, has been a very lost group of people that have done a tremendous damage to what I consider to be a great economic system. Mm-hmm. And so what we've had to do is try to, every time they come with something different, we have to try to manage through it, because they don't know what they're doing. Now, if you think about it, if you think right now, for example, that raising rates to blow up demand is the way to fix the economy, if people were thinking correctly, they might think, well, maybe if I gave some tax benefits or something to create supply, instead of having widgets that cost $10, I'd have more widgets and they cost $7. Mm-hmm. There's a different way to approach that. Right. I don't think they approach it correctly, but I have to manage through it. So when you're managing through it, and they've got sort of a hard head right now to get the rates up so they can get this inflation rate down to 2%. Well, in order to do that, they have to do a lot of damage. Mm-hmm. So you, as an investor right now, you need to start thinking about, how do I have less damage? Mm-hmm. Okay. Less damage to us is this, and that is holding a tremendous amount of money in very, very short-term paper. When I say that, I mean 24 months or less. Mm-hmm. A lot of floating rate paper, mostly treasuries, mm-hmm. because now I can get over 5% on 5.1 or 5.2. So for me to go out and start taking risk on owning and trying to catch the bottom, or try to figure out what the Federal Reserve is doing, I think people need to step back and say, well, that's what we're doing. Hmm. And that is, hey, we're going to be probably somewhere between 60% or so bulletproof right now. And we're going to see how this kind of pans out here. Now, the reason I say that is because let's just say, I'll give the wrong and right on that. Let's just say we're wrong, and all of a sudden everything goes back to like it was 3 years ago or something. Say it's or 4 years ago. Or say it, everybody's happy.
We go back to the zero bound.
Yeah,
which is what everybody's arguing for.
And okay, well, if we did that, we would still be okay with 5% paper because everybody else would be getting a half a point.
Right.
That's one thing.
Mm-hmm.
Let's say that we're right, though. And let's say that in order for them to get things like they want to get, you have to take the rates up to, say, 6% instead of a 5% Fed funds rate. Let's say we're going to go to 6 now.
I think they're going to 7, Ted, to be honest.
And Tom could very well be right. And what I'm saying in that is, by having a lot of short-term liquidity that's variable, we have a lot of variable treasuries. They reset every Monday, and they reset on the 90-day treasury rate. So right now they're about 5%.
Right.
And they're week to week. So, and if you come out, you get accrued interest. They pay the interest every quarter. And so if in fact that has to happen, 6 or 7, whatever, that means we participate all the way. Okay. That's what happens if we're right. I know a lot of people feel like that with where sentiment is right now, where the markets are, that it's all washed out from last year. But we look at companies, okay, and people might say you're a market timer, and I disagree with them. I will tell you what we are, though. We are a value timer.
Very good.
That is, if the value is not, and we screen companies, for example, we screen our best 200 companies we have on our list, and we have very few of those right now, very few, that are in a zone where we want, we just bought one new stock last week, but it was down 35% in the last 6 or 7 months. But see, what happens is those screens right now are not showing us anything that would tell us that, hey, you're 20% undervalued, even on a value basis, that you want to go into it. And when things are like that for us, we don't do a lot. And I mentioned this to a lot of people. I said, are you watching Warren Buffett? He's not buying a lot of things. No. He bought his own stock back, let's say, and that's okay. I'm not a big believer in that either. But so the main point I'm trying to say is that in these kinds of times, when you don't have any idea how far these people are going to go, you have to think about protection of your assets. Now we own about, Tom, in one portfolio, we own about 4% gold. The other one, we own about 7 or 7.5% of gold and gold miners. We have that in there. Naturally, gold tends to go with the bond market, but we're not going to throw the gold out, because I do think there'll be a time here where people will come back and realize that, this dollar is going to turn on me and go down. I know it's not right now, but it's going to some point in time. And that's your way of not having to do that. Plus, for us, the gold miners, for example, and again, this is not a huge position for us, but the gold miners are as cheap as I've seen them in 3 decades.
No, I agree with you completely.
And I told this on an interview last week. I said, Tom, I said, do you realize that the gold miners right now, the top 4 or 5, are paying higher dividends than the S&P 500?
Yeah.
Everybody's like, what?
Yeah.
Oh, yeah. Newmont's 5.5%, 6 almost. Yeah. I mean, people forget these things, and they start. And so there's been so much, I think you'd agree with me, there's been so much obsession with the Federal Reserve that they forget about investing. That makes sense.
Yeah.
They forget, okay, I'm over with the Federal Reserve, but that's not what you should be looking at. What do you own?
Yeah.
Okay. What's going to make some money for you the next 5 years?
or just what's going to give you the return of your money as opposed to you.
Yeah, exactly.
So, I mean, in this environment with the Fed funds rate at about 4.75%, 4.5,
Yeah.
and they're going to go to 5 probably in 2 weeks. They may go to 5.25, but likely probably to 5.
Mm-hmm.
And the Fed likes the PCE deflator as their inflation expectations guide. They've just barely inched back into real positive rates versus the PCE deflator, which is their measure for inflation, not necessarily the CPI, which I consider a completely gamified
that's true.
Concept. So you can see this is part of what you're just suggesting, what you're talking about, you're doing. When I was talking to Danielle DiMartino Booth a couple of weeks ago, she mentioned, look, the Fed's moving money back into the money markets, that the reverse repo facility, we've seen it drop from about 2.5 trillion down to around 2 trillion. And that continues. So as long as the Fed keeps raising, rates, they're trying to push money back into the money markets as opposed to just having it all be stuffed in a piggy bank for the banks to, have as excess reserves. Right. And this is also then feeding into the things we've seen recently where people are talking about, I don't understand what's happening. We got rates at 5% and a massive historic yield curve inversion, but at the same time, credit. So, the credit situation is pretty good because there's plenty of cash. And there's plenty of collateral. The Fed has kind of both sides of the domestic market. If the market needs collateral in the form of treasuries, or it needs liquidity in the form of dollars, it's got both on both sides of its balance sheet. It can always, if there was a real run on collateral, the Fed could easily just turn around and go, you know what, QT is running at 150 billion a month as opposed to 95. They can do that. They can change that guidance. So I've been focused on the Fed, and this is important for you to understand. I don't know how much you follow my work, but I've been focused on this as a means why I watch Powell, not from a position of, is he going to go 25 or 50? And this is part of it. It's more about the bigger general purpose here. Is the Fed becoming the central bank of the United States again after 20 plus years, as you pointed out at the beginning, the central bank of the world? Like under Bernanke and Yellen, this was very clear. Under Greenspan, I think the latter half of Greenspan's tenure is when it started. The whole Fed put under, and then I think in the response to 2008 through 2011, I've always said that the dollar reserve standard ended in 2008, and we went through an interregnum, and then the coordinated central bank era began in 2011 with the $500 billion slush fund, the top of the gold market, the whole worry about Brexit, and all of that happened when, Angela Merkel was trying to stop Greece from leaving the EU. That whole period from September to December of 2011, I think birthed a new kind of, the last stage of this insane monetary system we have. And I think that Powell has reminded everybody in the last, 18 months or so, no, that doesn't work anymore unless the Fed goes along with it. And so I think that's part of where we are. I don't know how you feel about that, but, but I think that's the broad strokes of what's going on. And every time you hear Powell open his mouth, this is what he's saying, and nobody wants to believe it.
That's true. I mean, I think, I've just put it like this. I don't think he wants to be remembered as the Arthur Burns of this particular time frame.
You said that directly.
Yes, if he doesn't win this war on inflation, so to speak, and I will mention a couple of things to you. Sure. I think one of the things people leave out, and they don't realize this, but if you look at your real estate taxes and my real estate taxes, and I have property in 3 or 4 different places and out of state too, they've all gone up off the charts. Okay. So these municipalities and counties as such, they have full coffers right now.
Yeah.
They're spending a lot of money. Now the Fed can't control that. That's one of the things they can't control. So they've got things going on here that I'm not certain they always try to look at, but I think from his standpoint, I think I think it will be longer because there's such an ingrained idea the last 12 years that this whole thing is easy. They won't stay there long. Don't worry. It's going to drop right back down and we're in nirvana again. I think people don't realize this time it's going to be longer. And in that length, I think he is basically wanting to say, you know what, I got approved for this job his approval for the job is when he started raising rates.
Yes, it is.
Almost the same month.
Yeah, it is. As a matter of
And I
fact,
think,
just to
yeah,
just to put a bow on that, because I followed this very, very closely.
yeah,
Biden clearly did not want Powell reaffirmed. He wanted to move Lael Brainerd in order for us to go full MMT zero bound retard.
yeah.
It was only after the Fed, the FOMC, voted Powell chairman pro tem until his reconfirmation. A similar situation happened with Greenspan during his tenure.
Mm-hmm.
Once that happened, Biden finally had to fold and then allow for the confirmation hearing. And then the minute that happened, like the next day, his rhetoric got hawkish, and then at the next meeting, he started raising rates.
Right.
And so it was very clear that this was a political battle that he had to outlive to get to the point of reconfirmation. And then he could start doing what he always wanted to do, and what the CARES Act put him behind the eight ball that he had to deal with. Like, look, Congress put the Fed in a terrible position
Totally.
in 2020 because the primary dealer banks had to monetize all this freaking spending,
right?
And there was nothing they could do about it. And I lay that at Trump's feet, if you want my honest opinion. So this is a very complicated thing with Powell. Just to understand that.
Well, I think too, if you and I know you remember this time, Volcker and Reagan were going at it.
Mm-hmm.
From about, I was in the business, and so from about 8% on till about 18,
mm-hmm.
Reagan was in, and if you remember, Reagan that was there with him, that came in from Maryland.
Yep.
They were beating on him to try to, but he wouldn't do it.
Yeah.
And he was at the same position. He's like, I'm just gonna, if you read his book, I'm just do the right thing, and I may not be remembered correctly, but and in the book, he basically says it's the only thing I could have done. And I think Powell is thinking, I may be wrong, but it looks like he's thinking the same way. Like,
I think you're exactly right, Ted.
You're
preaching to the converted here. I absolutely think Powell is looking at this and going, like, no. And Yellen is clearly against him.
Oh, yeah.
Biden is clearly against him. Oh, Biden is I put in.
Well, and now that
he's just Obama.
Brainerd in too.
Oh, yeah. Now Brainerd is they moved Brainerd into the Federal Reserve vice chair. She couldn't get the job she wanted, so now they're going to move her in. So now she gets the gold watch in the Biden administration for 2 years, where she can milk the system because she's a more political animal than she is anything else. Most of these people I think are rock stupid, and they're just political animals. Powell, the more I listen to and I look at Powell's history, I mean, he's no shining knight or nothing. I mean, he clearly represents Wall Street. But I think in the grander scheme of things, I think it's very clear that Wall Street sees, what you see, which is that we have no risk. We have no price discovery. We have no private risk assessment. They're in there playing the casino game because they had no other option, like a lot of.
And I think it caused people, I'll give an example. We never, we never owned any, we never were in crypto or NFTs, or we did no SPACs. We don't. If something doesn't make economic sense to us, if I can't explain something to you probably on one piece of paper, 8 by 11, you probably shouldn't buy it. And the point I'm making is that there are so many of those things that the only this always happens in these super bubbles that the Fed created. I'm trying to come around to something, is that even people that hold out, they finally just, I can't take it anymore. They're making so much money, I've got to go in, and then they all get wasted together. But here's what the Fed, if you look at 4.75% increases, they basically what should be a statement that says, hey, by the way, we made a mistake. That's their ability. They're not going to say it, but that's what they're telling you.
Yeah.
And I think he looks back now and says, man, I should have gone some different directions now. So I'm not going to leave it like in the middle of that. I don't care whether I get reappointed. I don't care about anything. I'm just going to get it like it should be. And you know what? We'll just have to endure the pain.
Yeah, no, I think so. And it's funny, and one of the things that I like to point out to people on a regular basis is that it's easy to make money in a bull market. Everybody's a genius because, well, it's a bull market, right? Yeah. Everybody, and it's like, you hit a home run, but you were born on third base, right? The kind of thing. And going all the way back to the beginning of your career, you're telling us about the Volcker days, right? And this is the interesting part about this. I wasn't a financial guy back then. Hell, I was a kid. And then I went to college and studied chemistry. I was a lab manager for many years and only got interested in this stuff in my 30s. By the way, after I lost money and I lost my ass in the .com bubble, right? It wasn't a lot of money because I didn't have any money.
Well, that's how you
It was
learn.
enough, right? It was enough that I took a loan out against the equity in my car to buy tech stocks. I was terrible. What I did was the dumbest thing imaginable. So, of course, I needed to figure out what happened. It led me to the Mises Institute. It led me to hard money. It led me to where I am today. So, it was an expensive lesson, but, it was also, my second college degree that I paid for out of pocket, or I handed to Wall Street. But what I've always said is that we have a lot of bond traders who don't understand that they made money trading bonds because they were in a primary bull market in U.S. Treasuries for 50 years. So guys who were, just getting into the industry in 1983 have never traded a bear market in U.S. Treasuries. They have no idea what that even looks like.
No.
And they're starting to get an inkling of what that looks like, I think, over the last year or so.
I've mentioned to a lot of people that my first 8 or 9 years in business, if you bought a bond, didn't make any difference whether it was a 1 year, a 5 year, or a 10 year. 90 days later, it was going to be lower in price because the rates were going up.
Yep.
And so you got a really hard lesson.
Mm-hmm.
And I had little old ladies come in my office. Her husband had died, and they had bought bonds for him in the 60s when they died. And they thought, well, I've got all this money, cash flow forever. Well, the bonds were 60 cents on the dollar. Plus, their cost of living was a lot higher than the coupon on the bond. You see, and that you learn a good lesson with that, because you realize that when that shows back up, you've got to have more of your money short term. You don't have to have 100%. You have to have a very high percentage of it.
Yes,
because you don't know how far it goes.
Yes,
you just don't know. And I thought all along that this particular bear market was going to be one of a normal bear market where you just keep people keep saying, okay, this is the low, the rates are done. Let's jump in, and they keep jumping in, it keeps taking them out. And I keep telling people this. I said, look, when a new bull market comes, you have plenty of time. Let's say you missed the bottom 8 or 10%. That's okay. All right. If it's a true bull market, companies are going to be cheap enough where you can still buy them. We're not there right now. As a matter of fact, a lot of these fundamentals are going the other way. The earnings are going down. You can't, you're not getting what you want to get. And so I think people need to realize where you are right now, because this just say that we're back into a 2000 till early 03, where you keep thinking everything's okay, and then 2 months later it's not okay, and then you think it's okay again, and then by the time you get to the end of 24 months or 28, 30 months, you're worn out. See, that's what happens to investors, and I don't see them right now being worn out, because they keep chasing, and I'm talking about chasing this crazy stuff. You just watch how they keep chasing Bed Bath & Beyond and AMC and things that they have nothing. There's nothing to them at all.
Right.
It's interesting to watch. And I was telling my investment committee, because I've got one of the best chief investment officers, I think, in the business. But I told Chance, I said, hey, it's interesting. They haven't learned. They lost a lot of money last year, but they keep coming.
No.
And so I don't know.
It's funny. I've described this like at each stage of this. I said the market is going through the Kubler-Ross 5 stages of grief over the death of the Fed put, and with each speech by Powell, with each new piece of economic data that doesn't pan out the way they want it to, like the jobs report at the beginning of February, or some big number, even if you don't believe these numbers, right? Even if you attenuate the jobs report from February from 517,000 jobs back to 300,000, right? Even if you don't literally believe it's like 66% nonsense, it was still a 4 sigma blowout over expectations, which were like 119 or something, right? So that's what shocked the market. And it's like, oh, look, an entire tranche of people just went from denial to anger And then more people went from anger to bargaining. Now we're getting into acceptance. And with each moment, you can see the turn psychologically and how the markets are starting to deal with it. And I think Powell's speech today before Congress shocked a lot of people again, and I watched the euro because I fully expect the euro to collapse. And with the change over in the leadership of the Bank of Japan, we may have our next catalyst for a big functional shift, right? But I keep seeing people like pile back into the euro and euro stocks, and of course Christine Lagarde is managing credit spreads and she's doing all sorts of crazy things. That's all ticking in behind the scenes, and very few people actually talk about it. But I'm like, why are you piling back into the euro? It's going to 95 cents. What the hell's wrong with you? Why would anybody buy a German 10-year at 1.2% less than an American 10-year? It doesn't make any sense. You want to talk about terminally mispriced markets, right?
And she's raising rates. You don't raise rates into a floundering economy. Right. I mean, that's not what you do. I mean, and so what you're saying makes sense because that's part of what's happening here. But it's interesting and I think another thing that's a problem for Powell is that if you look at the 70% of GDP is consumer spending, if you break that down, almost 70% of that number is in the fourth and fifth top quintile. Right. That's where all the money is. People keep saying, well, there's a lot of money here. Like, well, no, it's in that top quarter. Okay. The 75% below, they don't have any money. And so these people up here, look around, they're still spending.
Yep.
They are. They're doing houses, they're doing whatever they're doing.
There's a lot of overvalued assets in the marketplace, like California real estate. I live in North Florida. Okay. Yeah. I live north of Gainesville, Florida. And I can tell you that the geography of Florida, I've been saying this for years, the geography of Florida is such that Florida is not a monolithic property market. There's South Florida, the Southwest Florida, the Southeast Florida, the Central Florida.
Very familiar with it.
Yeah. So coming up to where I am, I can tell you that the money is starting to flow into my area of the state because everything else down below is too expensive.
Right.
I was talking with somebody the other day. There's a 10-day waiting period for new company formation in Sunbiz in Florida. Now, this is normally something that takes an hour. You want to form a company in Florida, like Sunbiz gets back to you with a number with a confirmation number within an hour. It's now 10 days. Yeah. Okay. It was 5 days a couple of weeks ago. Like, it's insane what's happening. The amount of money moving into Florida as people sell out of California, New York, Illinois, and all these other places. They're all moving here and they're all looking for cheap deals, and they can get it. And they can get it on commercial real estate. They can get it on residential real estate, and they can literally sell their hovel outside of San Francisco for $800,000. Come and buy 5 acres and a brick home in Live Oak, right, for $250,000 and overpay for it, and then take the other $500,000 that they after taxes and all the rest of it, and stick it in the money market and get 5%.
Exactly.
And then live off the interest.
And not pay state income tax.
Not pay state income tax and homestead in that $250,000 valuation to not rise by more than 3% a year, as long as they don't put an addition on the house.
One of the reasons we really stress the Treasury on a lot of our paper is because you don't pay state income tax on it. And a lot of people don't know that. And I think they're out here buying CDs and all sorts of things. I'm like, hey, you're leaving money on the table. But
right.
But what there's obviously, it's interesting. We're really bifurcating the U.S. again. We're breaking it up again, where people are going to the places where they want to feel freedom and do what they want to do, and some common sense. Right. And you really see maybe it's working in some of these other places. I saw this Chicago mayor election. Maybe something else is working. I hope so. But right now, that's why places where you are and those sorts of things, Tennessee, same way, no state. That we know all this because we go to 40 states and we know which ones are the most damaging. And so you got to keep that in mind. But I think people, I think, but like with real estate, for example, that's one of those assets that takes a long time to bottom out, a long time.
Yes.
And it's been so great that people, again, they forget and they keep going back in. I'm starting to see some things in real estate that are particularly in commercial,
Right.
that where the prices are really breaking down.
Yeah.
I'm talking about 25%, some properties, things like that.
Mhm.
Um, well, that's not necessarily the end of it.
No.
The end of it is where a lot of people get in trouble because
Hmm.
the debt's too high. And I've said this all along that people, they need to be leery of debt. I mean, it can really, I mean, the right kind of debt's okay if you have cash flow to offset it. But if you don't have, you need to really think about it.
I agreed completely. It's the way I advise people. I'm not allowed
Yeah.
to, I'm not an advisor, but when the ethos here is, look, shore up your own cash flow situation, effectively be your own central bank, have your own set of savings that you can then lever up into, once you have enough coverage there, then you can start investing per se. And if, all you're going to do is, what you're arguing at this point is like, I look at gold, goats, and guns as a three-tiered portfolio strategy. You have your savings, you have your industry, you have your investments, and then you have your defense. Very metaphorically speaking, very simple. Well,
Right.
what you're telling me is that you're in the gold portion of the portfolio. You're buying cash, you're buying U.S. Treasuries on a short-term basis in order to keep your cash balances high. You have a little bit of gold. You keep your investment into anything sincere has to be something that's going to generate a higher rate of return than you can get passively by buying short-term variable yield treasuries.
Yeah,
Correct?
we look for, what we're looking for in companies we own, and we own in a stock portfolio, for example, that we only have three strategies. But the stock strategy, uh, we're about 62, 34% probably liquid, when I say liquid in treasuries. And we own some companies, but they're companies that I'll give you just a couple of examples. But like if you look at MasterCard and Visa, I'm use that as an example. These are companies that can pay whatever debt they have, they can pay it off in 90 days.
Right.
Okay, you don't find many companies like that today. All
Yeah.
right. And you have to think about it in this term. If you're inflating, that means when you're spending money on a card, you're spending more money. If you're buying anything,
Right.
used to be $8, now it's $10. Well, you see how that's built into those kinds of investments. And so you have to look at things like that that'll get you across the valley. You can say what you want to about what they do,
Right.
but they're just a facilitator. I mean, they're not in the business of telling the bank what to charge and that sort of thing. But then again, we own gas pipelines. Well, natural gas and oil have to flow through a pipeline. I mean, there's some trucking goes on, but not much. Um, those are high cash flow,
Yes, they are.
8%, some of them 9%. Those that will work for us
Mhm.
because that's a tax deferred item, and plus we just feel like that people should be thinking about energy because it's probably going to get pretty scarce the next
So
two.
just to be clear, Ted, if I understand, you're talking about pipeline MLPs, master limited partnerships in general, or are you talking
Yeah,
about?
well, we have some MLPs and some non. I'll
Okay.
give you an example. We own, yeah, largest position in that portfolio. That's a high income portfolio. It's not a stock portfolio, but in a high income portfolio, we have enterprise products. Okay. We own the Plains America. We own the general partner, which is not a K1, but it's a 9% yield or eight and a
Right.
half. But, and then we own Marathon. And so we own,
Okay.
uh,
I just
different.
want to make sure that that I just
Yeah.
want to make sure that we broke it out because I've been in that space as well. I've been at times, happy to tell people, pipelines. I like shipping companies. Right now, I think logistics is a very good, especially global logistics. I think is a very good business because of the geopolitical situation of the West trying to cut Russia out of,
Right.
transportation. So that just means that anybody who's facilitating the rerouting of trade routes is going to make money because there's a demand for their services. So
Well, and you got to have it. And we're sort of stacking. I may be wrong on this, but we seem to be looking like we did say in late 1930s or something, where
Mhm.
all of a sudden, instead of Germany and Japan piling, teaming up on us, it's going to be Russia and China
Mhm.
teaming up on us. Now, I may be wrong on that, but it looks sort of feels like that.
It's definitely somebody. I mean, from my perspective, it's definitely we're the aggressors here. Not to say that the Russians and the Chinese aren't responding or in some ways being aggressive, but it's very clear that we're the ones with the financial, you
Mhm.
know, foundation that is crumbling. And as always, the dying empire always lashes out with the last of its money in order to try and militarily subjugate people, and that's never a good idea. And I also think that that's what's causing the functional split between various groups of people who are at the top of our infrastructure. Meaning that you have the ones that are desperate to try and extend this imperial system, for lack of a better term,
Mhm.
and then the costs of it rising to the point where how are we going to pay for it? Oh, well, we're going to just go and we're just going to create infinite amounts of money through MMT, and the banks and the Federal Reserve are going, yeah, and if you do that, you destroy the dollar and you destroy what's left of our business. And we're saying, you know what? No,
Yeah.
Congress, you're now finally being put on a leash after 50 years. I
Well,
don't know if
I
it's
think
going to work or not, but I think that that's what I'm seeing.
I think you're right. I think in their arrogance, they thought, well, we can do anything. So we're going to take all these reserves from Russia and we're going to lock them down.
Mm-hmm.
They won't get them, not realizing it was going to backfire on them. Because now you probably have a dozen countries, including Russia, China, Saudi, Iran, Iraq, in South
India.
America. They're basically saying, wait a minute, if you could do that to them, then you can do it to me.
Mm-hmm.
That that one thing, in our opinion, at least, is going to change the way a lot of trade goes. Talking about your logistics and things, and so it'll be interesting to see how it comes out. But I don't think they realized that the world wasn't going to jump on their side and say, "Oh, you're great. We're glad what you did." They're more like, I mean, I've been talking to friends of mine in Vancouver, and they tell me that the real estate's going down a lot. I
Mm-hmm.
said, why? They said, well, because a lot of the people from China are like, we're out of here.
Yep.
If you can do that to them, you can certainly do it to me.
Yep. Yeah,
Now,
and
I
we
don't
and
know.
we of course say we of course put out the propaganda saying or whatever that
Right.
like Mark Mobius the other day saying, well, I can't get my money out of China. I'm like, I don't trust him as far as I can throw him. I remember studying his work 10 years ago when I used to work with a guy over in Vietnam. Oh, by the
Yeah.
way. So it's like how many times do I have to listen to the newest version of Kyle Bass telling me that Japan is going to implode tomorrow? Like I'm
Yeah.
done with a lot of that stuff. So no, that's a very interesting point you made about Vancouver real estate. The minute you said the word Vancouver, I'm like, oh yeah, the Chinese are pulling out because I know
Yeah.
that the Vancouver property market is very much a
Well, it's interesting. You're obviously very, very well versed. I will tell you, a lot of people that are out there are not as well versed as you are. So we tend to listen and watch people that are well versed, or if they manage money, I really like to talk to them too. I want to see what they're thinking. I mean, I agree, but maybe we're doing something wrong. You
right,
know what I mean?
of course.
Uh, and I'm always open to see it as I always ask this question of our portfolios, and that is what could go wrong for us here? I'm talking about us, me,
Yeah, of
Oxbow.
course.
And we're always asking that question. And I have to tell you, one of the things I feel bad for right now in the country is our small investors, the people that have, say, less than 500,000, that's all they have, or especially less than 250 or 300, because there's nobody to help them.
Yep.
Not really.
No.
And they've gotten this advice, which is, oh, just put it in here, put it in there, it'll be okay. Look at it 20 years from now, it'll be okay. But there's nobody there to work on. And then I have to tell you this, we're not on the broker dealer side, but I do own part of one that has nothing to do with Oxbow. But one of the things that's happened that's really detrimental is in thinking the government and thinking they were trying to help the little person in a broker dealer, they put rules in so that if you buy or sell something for the small investor, you literally have to fill out a couple of pages. Okay. So you think about this now. I'm not in that business, okay, but I know how they're thinking. And that is, hey, I'm not making any money off this little person. So if I'm not, why am I going to fill out 2 pages and take the time to call them? Can I make any money anyway?
Right.
You see what I'm saying?
Oh
So
yeah, no,
there's,
absolutely.
I feel sorry. I really do uh, feel sorry for those people. And when they come to us and they're saying, we obviously are on a fee base and we can't take those kinds of accounts. But well, what I do for them is I say, look, we'll put you on our email. I'll do as much as I can for you. Okay. I'll put you on the email list. I'll send you new books we print. I'll show you our interviews such as this, but that's a group I really, I feel for.
I think it's part of what the quote unquote the newsletter industry is supposed to help us with, right?
Yeah.
I've been involved in this now as when I first got picked up by Newsmax back in 2013 to write a gold newsletter for them. We morphed it into a more commodities based thing, and then eventually I'm on my second stint with Newsmax. I now do Ultimate Wealth Report for them, which was never that was never the focus. I turned it into that focus because that's where my head is. But the goal here and the ethos, for this is to try and help those people who don't have anyone else to try and give them the right advice. And so this has been very valuable because I hadn't really thought about, I'll be honest with you, when you said the variable rate short-term treasuries, I was like, well, that's the money shot for this whole podcast as far as I'm concerned. This is the thing I think that those people need to really listen to. You have so many, I've been saying things like, I've been telling people like, look, at this point in time, if you've got a little bit of money, start buying some 6 or 9 month CDs and buy like one every month for a couple of grand or whatever. If you've got a little bit of money, and then roll them over and let them mature and do the thing, right? So that you're constantly, you can play the game on the way up as the rates rise, and then they fall off. Right. But if you can do so in such a way that you don't have to pay freaking taxes on it, well, that's even better. Right. And then, so there's another, this is the kind of thing that, people have to really think about. And because if you buy,
they didn't have it before, 2 years ago that we owned some variables then too. They were 1/4%.
Right. Right. I mean, how are you supposed to make any money at 1/4%?
Yeah. And everybody was getting the same thing. And so, I'm part of a good bank. I mean, it's a very good bank, but it's private. But, last year was a record year for us because rates went up, but nobody was paying anything. Right. All banks were like this. Right. Well, this year, different game. Mm-hmm. People are moving money around. They're doing things. And one of the reasons, I will tell you this, Tom, one of the reasons that a lot of investors don't get a chance at things like those treasuries, that's variable, the brokerage firms, they don't make any money on them. Mm-hmm. So they're not going to offer them to you unless you go buy them.
Right. Now, you can buy them yourself.
You can buy them yourself at, we were at Schwab, TD Ameritrade, different. We custody different places, but if you can go in and they'll have them, you can buy them. But if you take a normal Wall Street investment firm, all the big names, mm-hmm. they're never going to open that because they'll make any money.
Right. No, exactly. But it is a very interesting strategy at this point in time. Look, and this is another point you mentioned earlier about Newmont, for example, paying significant dividends for the first time because the gold industry actually doing that. And that's an outgrowth of them trying to figure out a different way to finance themselves and then attract capital from there's a holdover and evolution from the last bull market, from the end of the last bull market when they overpaid for property and they went crazy. And that whole industry is actually much different than it used to be, which is a good thing. But the thing that you now have to really think about is that, look, you can get 5% passively in money market or 6-month CDs or whatever. Just watch the short-term yield curve. You now have to really think seriously: is that 7% that you're getting from this company that 2 years ago was the way to get yield? Today, mm-hmm. It's like it's only a 2% net over what you can get practically quote unquote risk free. And so
you've got a point on that. And I'll tell you why. If for all your listeners out there, this, but I'm not certain they do. And if you look at the earnings yield, which is flip the price to earnings and go earnings to price, mm-hmm. Look at the earnings yield right now on the S&P 500. It's exactly the same as the Treasury 1 year.
Right.
Okay. So you think to yourself, now wait a minute. Why would this is what happened today. This is why the 87 crash happened. Greenspan ran the rates up and people looked at it and said, wait a minute, I can get about the same for 5 years in the treasury as I could in the market, I'm out of here.
Right.
Well, we're getting to that point now with the earnings yield on the S&P 500 is like they're both 5%.
Mm-hmm.
So if you're like, well, okay, I think I'll take the treasury.
And honestly, I think that that's part of the Federal Reserve's plan here. It's like, and this is,
Yeah.
and in the greater context of this, and this is what I always focus on, because once you kind of internalize it, and thank you for that. That's a great, concise way of looking at these things, and a good historical note. But I start doing okay, so what does this all mean in the context of the big global shift? I personally don't feel that the Fed is raising rates to fight inflation. They're fighting you mentioned it earlier. You mentioned, could we do something about supply? Because this is a cost push, supply based problem, inflationary problem, as opposed to a demand pull problem, right? I say, yeah, the Fed has the demand side tools, interest rates, that they don't solve cost push inflation. So the Fed is doing something else. And the Fed is raising rates and using inflation as the convenient kind of Keynesian cover story. I'm not saying that the Fed is no longer Keynesian, but there's something about what Powell's doing here that is not Keynesian orthodoxy. And that's what I think a lot of people can't seem to meet in their head.
Yeah.
There's a different game being played here, and it's about the globalization of dollars and who controls the global flow of dollars. And I think that we got, as a society, global society, and a global financial markets, got way too used to the fact that the Fed is a passive observer of whatever it is that the offshore dollar markets wanted to do. And that is changing.
Yeah.
And that's a completely
Yeah,
different
he seems to
discussion.
want to, he seems like you're saying, he seems to want to, I don't know this, but
Sure.
I'm just guessing, but he seems to want to see, we haven't had any normal economic turns in a long time because they would always run and juice the market. And we got to where instead of the market reflecting the economy was reflecting the market. So they went that direction. But now I think I'm just watching, but it seems he wants to leave a legacy as, okay, we're back to normal economic ebbs and flows.
Mm-hmm.
Now, whether we get there or not, I don't know.
No one knows. But yeah, this is an interesting thing. I just wrote an article the other day, and and when I get done with this conversation, I'm going to write part 2 of that article, talking about the kind of the global demand for dollars. But the world is shifting, right? We are moving to SOFR here in the United States. LIBOR is ending. Mm-hmm. Everything about the structure of our markets for the last 70 years changes with the switch over from SOFR away from LIBOR. No longer does what happened in Europe and anywhere else matter to the American banking system. And this is a very important point. And the CME, the Chicago Mercantile Exchange, reminded everybody quietly in October, said, by the way, Eurodollar futures are not going to be a thing after April. And then they just reminded everybody they came across the Schwab desks on Monday of last week. Oh, by the way, all Eurodollar futures contracts, dated after June of 2023, which is the end of LIBOR, it is ending. They're done, and your positions are going to be closed. You're only allowed to now to trade to close your positions, because SOFR futures now dwarf by a factor of 10 to 1 the liquidity of the Eurodollar futures market. So it's no longer necessary, which, by the way, was the plan all along.
Yeah.
Going all the way back to when Powell was originally appointed, and John Williams who is the architect of SOFR, was put in charge of the New York Fed over the wailing and gnashing of teeth of every Democrat and every globalist European investor. They all scream bloody murder. They all question. Go back to read stories about Williams' appointment to the New York Fed, and they were all like, "Who is this guy? He's not competent to do this." Like, really? Interesting. Huh? You don't say. Like, this is the way I read these markets, because it's all politicized at this point. But it's clearly someone's ox was being gored by the appointment of Powell and by the appointment of Williams. They almost got Judy Shelton on the board, who's a known advocate for as a return to a gold-based commodity money standard. And I think this is the fight. This is the real fight. And I think we're all kind of caught in the middle of it. And we're in that moment in time when we're not sure who's going to win.
Yeah.
But if you want my honest opinion, I think Powell's already won, because the Eurodollar futures system is dead. It's a dead
Right.
market. And he's already won. But I don't know. I'll give you the last word on the way out here. I just wanted to throw those ideas at you because I don't know if you've actually thought about them at all. But this is what I've been like obsessed with for the last 2 years of my life,
Sure.
honestly. So, but I really enjoyed this. I was very pleased to get to know you today. So, happy to give you the last word on the way out, though.
Tom, I've enjoyed visiting with you. And obviously, you're very well versed, well read, and I think that's a mark of a great interviewer, if you want to know.
Mm.
And I appreciate that about you. But I would just tell people on the way out, I mean, don't necessarily take, there's a lot of people in this industry that have only been around. In fact, if you go look this up, the average tenure is 10 years in investment business. Okay. That means that you're talking to a lot of people that have never been through many things at all that are bad. And so I would caution people to be, really seek out good counsel to what may or may not happen the next 5 years, and don't underestimate the ability to have some protection. I would say that.
That's a perfectly good way of putting this. One of the things, and I've been doing this, my journey to this point has been purely self-taught, and I've tried to listen to the best and brightest minds in the industry on all sides of the fence, and then bring my own, kind of unique spin to it. But, it's really important that even as we all do this, we're all on a discovery journey here every day. The only way the markets teach you one thing, if they teach you nothing else, they teach you humility. That what you think you know today is not what is going to happen tomorrow, and this is the reality. And so we all have to constantly be on our best game, and not just.
I've said this many times, but I'm fairly certain that I've been wrong as much as anybody. Okay, and so when you're talking about be humbling, I've been on my knees for a long time because I stay that way.
You have to. And I think that in a certain level, I don't, I'm not in any of my discussions about this. I'm not trying to lionize Powell. I'm not trying to,
Right.
I'm not trying to whitewash anything. He's a bureaucrat. But he has a perspective. And I just remind people that personnel is policy, and he is not the same person as Greenspan, Bernanke, or Yellen. And his Fed, his FOMC is completely different. And you can see that with the political response to him. And I think that is the ultimate thing to just watch. And then, you can fill in the details as the royal you hear, as you see fit. The goal here on our perspective is to, present as much information as we can and have you make the best decision. So Ted, thank you very much for everything. This was a great talk. I'd love to do it again in the future and get your ideas about what happens when we're closer to what I think is going to be the terminal rate. And then it may be a very interesting talk then.
Thanks, Tom.
Thank you. You have a great day now, sir. Thank you. Well, that'll about wrap it up for episode 136 of the Gold, Goats, and Guns podcast. I want to remind everybody that you can follow me and my work over at my blog at tomluongo.me. You can follow me on Twitter at TFL1728. You can also sign up for the Patreon at Patreon/Gold, Goats, and Guns, where we do a monthly investment newsletter as well as twice weekly video market reports, going over technical states of markets, doing a little bespoke research and chart reads for the patrons, and some private blog posts and some of my best ideas journaled there first before they go out into the rest of the world. So if any of that sounds good to you, then, hey, click the link, do the thing. You know how it works. So you guys be well. You take care. We'll talk soon. Keep your stick on the ice.